Welcome. I am Christy Luzar. I'm the Executive Director of the Urban Economic Development Association, or UEDA, and we are glad that you could join us today for our first Emerging Topics series in economic development, which is focusing on special purpose credit programs. And so we're very excited. We have a great panel of speakers here today to really share how they see this, what I think is a very dynamic space right now in economic and community development and fair lending. So we're very excited to have you all here with us. So we will introduce our moderator and our speakers who will do some presentations around SPCPs in different frames. So you'll get an overview. So if you don't know anything about them, this is a great opportunity to learn. One of them will talk about them developing SPC products and then how they are looking in practice. And then what do we see looking forward? And then we'll check in with you all and share some resources. And yes, we will share the recording and presentation after today. So we are going to do a poll, and I'm hoping this works now, to just gauge for those of you that are with us today, you know, how familiar are you with special purpose credit programs? So please pick your choice. Your level of familiarity. And seems like we've got a good mix of knowledge bases, which is what we're hoping. I will say this was a topic that was suggested by more than a few members earlier this year for us. And our presenters will get into the reasons why I believe that is so. But I'm excited. I also think of this as a fairly wonky topic. And those of you who heard me say the energy efficiency lighting in my office goes off on its own.
I was gonna say, I think we have all of our answers on our poll as well too. So I believe everybody can see these results.
All right. Wow. It's a good mix. So our speakers will adjust accordingly, I think. All right. So just a little bit about UEDA. If you are, and actually, did you share the results, Kat? Sorry.
I believe I did.
Okay, good. Then I will close that. Just a little bit about UEDA, if you're not familiar, though I think many people who registered for this we are a membership association of people and groups that work in community economic development. And we frame our work really around collaboration, capacity, and connection. So you see that reflected there in our mission, vision, and values. Many of you are probably involved in our programs, which include Bank On, Greater Milwaukee, Take Root Milwaukee. And then we do a lot of capacity building and technical assistance. And I would be remiss if I did not say, become a member. If you are not already a member, join our mailing list and get involved. So you can see our website address there. And Kat, I'm going to hand it over to you.
Yeah, this is a little bit about our Emerging Topics development series, which this is a part of. This is an annual event that we do usually in groups of 3 that was started in 2018. And it's all about relevant learning and training opportunities for Southeast Wisconsin. And we like to engage a broad range of people in purposeful dialogue, learning, and collaboration. I'd also like to just give a quick shout out to our partners and assistants to this session: Bethany Sanchez, Bill Kopka, Carol Maria, Irma Klassen, Jessica Knopf, Lamont Davis, and Maria Prioletta for all of their work helping these and our future sessions, which we'll talk a little bit more about at the end.
Yes, and thank you to those UEDA members who have also been very involved in the planning for it. Take Root has been doing a webinar series on racial disparities in homeownership. And so this topic actually is very connected to that, as we'll talk about in a minute. And I also want to thank our sponsors who support UEDA and this series in particular, US Bank, Associated Bank, and Chase. And likely we will have a couple more joining us as we move through the fall. But their support has been so critical to us being able to hold these series, and particularly as we do them in person. So our next one will be that, but they help offset the costs and support UEDA as we do this work. So we thank you. Hats off. And so we just have a quick slide where we're going to kind of say like, why this topic, why now? I think those of you who are on the call and the webinar will have a good understanding. We were widely sharing these links to 2 blog posts that the Urban Institute had released in the last like 6 months or so, really talking about special purpose credit programs and the 2 ways that you think about them, place-based and people-based. And there's a quote here that really talks about why they are a critical tool, because a lot of people really see them as a way to address the historic impacts of redlining and the Black-white homeownership gap, the racial disparities in homeownership. And so, for example, you see that the gap is as large today as it was before the passage of the Fair Housing Act, as well as you can add Community Reinvestment Act. And so why now? Well, about 6 or 7 months ago, there was some recent federal guidance on SPCPs and fair lending. So that has really increased energy around this. But really today we wanted our presenters to really talk about how it's really to increase this awareness among lenders about the product tool and think about, let's go beyond affordability. So now let's not just think about LMI communities and sort of assume that that will help us achieve racial equity goals. And so over the past couple of years, we all know we've seen really significant changes in how we talk. And I would say, think about racial and economic justice since the murder of George Floyd. And so this is a critically, I mean, these are things you're working within systems. So what can you do to disrupt systems and really address the impacts and legacy of discriminatory lending? Well, SPCPs are a way to do that. And so our presenters really share some of their thoughts on that. So we want you to keep that in mind. Go beyond affordability, as we say. All right, Kat.
Yeah, so my name is Kat Claus. I use she, her pronouns. I am one of your hosts today. I am the Communication and Events Coordinator for UEDA, the Urban Economic Development Association. We also have my boss, Christy Luzar, the doer of all things, our Executive Director. And lastly, but not least, we are very fortunate to have our moderator for today, Carol Maria from the FDIC. Carol is a member of the FDIC's Community Affairs team. Her work focuses on community and economic development partnerships in the state of Wisconsin. So welcome, Carol, and thank you so much for joining us.
Thanks, Kat. I'm really happy to be here to help you with this.
Well, I am glad. So we will hand the reins on over to you with our first presenter to kick the day off.
Well, thanks so much, Kat. So today we're going to start with Brad Blauer with the Ncrc, and he's general counsel, and he's been working to promote economic equality and access to credit for years. He's focused on civil rights and consumer protection as an advocate. So Brad, did you want to open your camera and we're going to go ahead and keep moving along?
Sure. Good morning, everybody.
Thanks.
So I'm going to start out, we can move to the next slide. Going to kind of frame the topic for today and talk a little bit about, what are special purpose credit programs, or SPCPs, as a little bit of a tongue twister. You'll hope people use that acronym. If we move on to slide 11. So what are SPCPs? In terms of context, we're all familiar with the Equal Credit Opportunity Act and other fair lending laws, federal and state, that prohibit discrimination on the basis of protected class. So you're not supposed to discriminate against people or treat them differently based upon race, national origin, sex, age, marital status, religion. But there is an exception. You can treat people differently if there is a history of discrimination, history of a community being underserved. And so there's a provision of the Equal Credit Opportunity Act, which says that you can create a program as a for-profit lender. And there are other provisions that relate to nonprofits, but this is a provision that relates to for-profit lenders, can create special programs for protected class members who would otherwise not have received credit or would have received on less favorable terms. And that there's also provisions in Regulation B, which is the regulation that implements ECOA, that has similar language. So it's a special exception that says, yes, you can discriminate in a positive way to serve underserved communities. Can we turn to the next slide? So what are the basics here? Again, as Christy mentioned, it's addressing the wealth gap, the racial wealth gap, permitting lenders to reach historically underserved communities. And there are a variety of ways that lenders can do this. first of all, for-profit lenders can be pretty direct. They can say, we're going to link this program to serve communities based upon demographics. We're seeing that based upon our lending patterns as a bank or fintech or some other kind of lender, that we're not serving the Hispanic community. You could develop a program that's geared for the Hispanic community where you do business, or any of the other protected classes. And we'll go a little bit more into as the presentation goes on about how you do that appropriately. You can also, some lenders are defining SPCPs by geography. There may be a neighborhood or a census tract that's been traditionally underserved. And some lenders feel a little bit more comfortable designing their SPCPs to geography to kind of inoculate them to a little bit degree from some kind of lawsuit that might be brought challenging the SPCP under the Equal Protection Clause. Even though, there have not been successful challenges to the program, it's totally supported by both the law and by the regulators. And then another way that some SPCP programs are developed is to use your status as a first-generation home buyer or a first-time home buyer as a way to target lending products, with the idea that geography and status, are both kind of, in many ways, a proxy for race and ethnicity, because those communities are the most underserved in our country. So we can turn to the next slide. Other things to think about are, that SPCPs also often involve targeted marketing. So a lender could over-index or provide additional marketing and materials and ads on the internet to communities that have been traditionally underserved. That's typically part of an SPCP program. And one thing we should be thinking about throughout this conversation is it's not just mortgages we're talking about that can be a special purpose credit program. You can provide personal loans, small business loans, and then also even capital to community, to developers who are providing housing, for instance, in communities. Those can all be SPCP programs. We'll go to the next slide. So why are SPCPs needed now? As Christy noted, there's a big gap between homeownership and credit products, between minority communities and white communities. And the Black homeownership rate, for instance, has been stagnant for the last 60 years. It's resting at 42% as compared with the white homeownership rate of 72.4%. A 30% difference. And that really it's gone a little bit up, a little bit down over the years, but that gap has persisted for about 60 years, well before the passage of the Fair Housing Act of 1968. And Black homeowners, on average, are paying more for loans because of this lack of availability of housing. And so that's why SPCPs are needed. This provision, this exception that allows you to discriminate in a positive way, has been part of the statute, since for the last 60 years. But we need, in this time we're in now, it's greatly needed because of this racial wealth gap. Next slide. What do you need to do to create a special purpose credit program as a lender? Well, first of all, you need to identify the class of people that will benefit from the program and provide, you basically need to have a plan in your file as a lender that you can show to a regulator or another group that perhaps is asking you questions about why you've created this program, that demonstrates that you've thought about why it's appropriate in this instance to discriminate in a positive way. So you need to demonstrate, as the statute provides in the exception, why this group would be otherwise underserved by your underwriting criteria, by your eligibility requirements, but for this program. And you need to provide data in your plan. It can be your own proprietary data, or it can be Home Mortgage Disclosure Act data or other data that you have that shows that these communities would be otherwise not as well served but for this program, to demonstrate and justify the program. You also need to describe the procedures and standards you're going to apply. And if you do start a program, you can't use stale data. You need to periodically go back and reevaluate. Has your program been successful? Can you sunset it because you've actually achieved a bit of the benefit that you hope to achieve, and now you're not seeing the same rates of difference from one community to another? Perhaps the program should be discontinued. And that will also help protect you if there's a lawsuit later on to show that you're using very timely data to demonstrate that this class of people would otherwise not be able to benefit from your existing standards when you're defending your program to a regulator or in a lawsuit. So we go to the next slide. Some examples of SPCPs that we've seen, including with US Bank and Chase, who are the sponsors of this event. Both of those lenders have developed down payment assistance programs based upon geography in the mortgage space for underserved communities. That's one example that allows a borrower to get additional assistance than they would have otherwise received because they live in an underserved geographic community. Another example are second look programs for personal credit. So for example, if you wouldn't have qualified for a personal loan based upon a lender's traditional underwriting criteria, but you came awfully close, the lender could create a second look program. We're going to go back and look at those applicants who, with our traditional criteria, would have been denied, but we're going to expand additional criteria that we'll look at, maybe that would allow them to be qualified. For instance, your rental payments over the past period of a year or two, or your utility payments, other kinds of indicia that you're a creditworthy, sustainable applicant, and that the lender should make a loan available to you. So those are second look programs. And as I said before, targeted marketing is also usually part of a program that's just designed to meet the needs of the protected class. So the next slide. So some watch outs. You need to make sure that your program is at least as favorable as the other programs you offer. So you certainly don't want to have an instance where you create, let's say you create a Hispanic credit card, but it's not as advantageous a program as the traditional credit card that you offer more generally. That would be a no-no. That would be basically targeting a discriminatory product to a protected class community. So you have to be very careful about reverse redlining considerations, which means you're actually targeting a disadvantageous product to a protected class community. And you need to be concerned about steering in the way you design your products. You don't want to be steering, for instance, African-American borrowers in certain communities to only live in certain areas of the community where you're doing business through an SPCP. And you also need to continually monitor market conditions to ensure that your program that you're offering remains a favorable program as compared with your other products to that protected group. Go to the next slide. So as Christy mentioned at the outset, the stars are kind of aligned right now under the current administration for SPCPs. The Cfpb, the Consumer Financial Protection Bureau, put out guidance, and the Cfpb has really been a leader in the SPCP space more than a year ago, or almost 2 years ago now, to say, put out an advisory opinion that these programs are fully compliant with the Equal Credit Opportunity Act. And about a year later, HUD provided kind of follow-on guidance to say, look, not only are they compliant with the COA, but they're compliant with the Fair Housing Act. And so I have an incomplete reference there. It's compliant with both a COA and the Fair Housing Act. It would be inconsistent for instance, a mortgage product to be fully compliant with one set of fair lending laws and then to be held by another federal agency. Well, you're not compliant with the Fair Housing Act. That would totally undermine the purpose of the SPCPs and disincent lenders from doing the program. So the regulators have harmonized their position that, yes, we want mortgage lenders, we want small business lenders, we want personal loan lenders to be making these loans, and they're fully compliant with federal fair lending laws. And just as an example of a recent program, US Bank, again, one of the sponsors here, recently entered into a community benefits agreement with Ncrc and the California Reinvestment Coalition just in May of this year. And they included 2 large SPCP commitments in that program. They're going to provide $100 million in down payment assistance commitment and mortgages to certain communities with a high percentage of minority and minority applicants. And they're also going to provide $125 million in capital commitment to minority-owned housing developers, which is another form of SPCP. So this is a huge commitment, and we're hoping to see more of this from lenders in different sectors. So the next slide. And this is my last point I'd make is, why should lenders do this? What's, it's okay to be selfish and also serve your community at the same time. And there's a selfish interest here for lenders to really embrace SPCPs. First of all, as a business, you want to increase the size and diversity of your client base. And that really improves your viability and sustainability as a company. You're not just serving one targeted community, you're serving all the communities, including the communities of color where you do business. It potentially helps you satisfy, as a lender, your community reinvestment Act goals. And the regulators recently put out a notice of proposed rulemaking under the CRA that asks for comment on whether SPCP programs you should get credit for them as a lender under the CRA. Other things to think about as a lender is, increasingly millennials and other generations, want to feel that their business is really giving back to the communities where you do business. And SPCPs are a great way to make your staff and employees feel like they're part of the community. And finally, there's a very selfish interest here. You're doing the right thing. Not only are you doing the right thing, but you're really mitigating your fair lending and fair housing risk. If a regulator should put their, as part of their supervisory exams, ask you, what are you doing in terms of lending in communities of color and other protected areas? You will have a record that you are not only providing traditionally sound programs, but you're leaning in and providing SPCPs to serve those communities where you perhaps feel like you could be doing more based upon your record today. So there's a very good reason for businesses to do this, not only because it's allowed and it's the right thing to do, but it's a profitable area that you can provide sustainable lending. And so with that I'll turn it back to our moderator.
Thanks, Brad. And thanks for jumping ahead a slide. I think we had a slide with Brad's contact information there. And I just wanted to really thank him for using 2 words during his presentation. One was harmonize. I think sometimes practitioners in the field forget how many regulations banks juggle as they move forward with new ideas, and mitigate, really landing on that idea of mitigation. Because our question is, using a fair lending perspective, Brad, what does Ncrc see as the future for these products?
I would say that what we see is increasing traction in the variety of these kinds of programs. That's the thing that I really I'm optimistic about. We're seeing, and I gave the example in the presentation, we're seeing not only SPCPs in the mortgage space, which is, I think people can easily fathom, providing additional down payment assistance and other assistance there. But even in the personal lending and small business lending space and providing capital to housing developers, there's a lack of affordable housing out there. And if we can provide through SPCP programs, the capital that will allow additional affordable housing to be available, that's really going to help with the housing crunch. So I'm optimistic that we're seeing just a variety of these kinds of programs starting to flourish.
Thank you so much. I think that your ability to explain the regulatory construct of these new solutions is really helpful for the group. And next, we're going to have 2 speakers that talk about specific applications of the products. And our first up is Jeff Cooper with Mgic. And many of you in the UEDA community know Jeff, his work with mortgage finance, UEDA, and the state office on Commissioner on Banking. So Jeff, did you want to open your camera there? And there we go. So we're so happy to have you here and really represent Mgic and its work in this space.
Great. Well, thank you. Thank you, Carol. Yeah, and Brad did a excellent job really kind of highlighting special purpose credit programs and following the path to where we are today from Reg B, which implemented ECOA. What are we talking about now? 52 years ago. And here, no, 47 years ago. I have to do my math a little quicker. And here we are yet at the precipice of a point in time where I think special purpose credit programs are going to start to be used more. We're certainly seeing that. And my intent here is to talk a little bit about what we're seeing in the market. But first, a bit of background. Who is Mgic? Many of you may know us. We're really the nation's largest mortgage insurer with $287 billion of loans in force. And that's as of June 30th. And we also are the industry's market share leader in 5 of the last 6 quarters. But there's sort of a legacy here. And if you go back 65 years ago, Milwaukee real estate attorney Max Carl founded MGIC, and in doing so, he created the modern day private mortgage insurance industry, which today has 6 companies that collectively last year wrote insurance on over 120 billion, over 600 billion in risk. So we like to say that MI is the original DPA. Today we talk about down payment assistance, reducing what the borrower needs to bring to the closing table from 3 or 5% down to something south of that, maybe 0. And if we go way back when MI was founded, banks at that time were doing conventional portfolio lending with 20% or even 33% down payments. And it was MI that allowed down payments to continue to get lower and lower and lower, in conjunction with Fannie and Freddie's chartering to today get us down to where we are with a standard 97 LTV mortgage. And in that time, really since 1957, we've helped over 40 million families purchase or refi with low down loans. And another key note is since the GSEs entered conservatorship, we have paid 60 billion in claims as an industry since October of 2008. So we could jump on to slide 24. So much of what's on this slide is really been addressed by Brad, but I kind of want to follow the path and just make another few key points in here. And I think it's really important. As we talked about, 1975 was when Reg B implementing ECOA, incorporating the special purpose credit program provision was made. What's important is ECOA applies to creditors. There are a lot of entities in the path of a mortgage loan today which are not creditors and to which this law doesn't apply. Fannie Mae and Freddie Mac, for example, are not creditors, yet they are working towards implementing programs which will facilitate special purpose credit programs. Mortgage insurers are not creditors under ECOA, but as we're going to talk about here in a moment, we too are supporting efforts to try to develop meaningful special purpose credit programs, which eventually will move the needle and start to close the homeownership racial and ethnic gaps in homeownership, which are persisting. One of the key things here, and Brad talked about the concept of a common characteristic. And in the law itself, it really kind of drives to the fact that common characteristic can in fact be a protected class. And that you can, in fact, I think the term I wanted to draw out here is that you can prefer a member of an economically disadvantaged class with a special purpose credit program, but you can't intentionally harm somebody else of a protected class. So the goal is to uplift a group that is underserved, to serve them, to provide them greater access to homeownership or better financing terms, and meet a need that today is not being met. That is the goal, and that it is within the context of that a creditor can be proactive. So we kind of went through this period of, as I mentioned, about 45 years where special purpose credit programs were in the law. They weren't broadly used, and they really weren't getting much attention. In December of 2020, largely due to a groundswell from civil rights advocates and housing advocates and banks themselves, Cfpb did issue an advisory opinion. Brad also covered this. I think the key thing that came out of that, and I want to draw your attention to 2 things in that. If you go to the Cfpb's website and look at this, it's important to have a written plan. It's a requirement to have a written plan. And there's a number of criteria that need to be met in that written plan. Most important, though, is your assessment in a broad way of what the need is. Who are you targeting with the program? And then how are you intending for your program? How will your program meet that broad need? And then either you term limit that program, maybe you do a year or 2 years, or you set up a structured path to revisit. Are you moving the needle? Are you achieving what you set out to do with your special purpose credit program? And as a mortgage insurance company, when we're working with a lender who's coming to us on a special purpose credit program, we do want to see that written plan. We ask for it. We'd like to see how they're seeing the need. how they're seeing the community partners that are going to help them address that need. And we're looking for really trying to understand how they're thinking about it. So the CFPB advisory opinion was very positive. It moved everything in the right direction. I think the industry discussion about moving towards implementing special purpose credit programs really picked up, but it didn't explode. And there was some reticence and hesitancy on the part of lenders to jump into the fray, really until December of last year, when the HUD Office of General Counsel provided the guidance everybody was waiting for. And basically, I'm going to take the word that Brad used and that Carol reinforced. What they said in their guidance is that if you follow the special purpose credit program provision of Reg B and ECOA and follow the spirit of that, you will not run afoul of the Fair Housing Act, most likely. In other words, they indicated that the laws, special ECOA and the Fair Housing Act are really harmonized. That's the word that I think is key here. So there was concern up to that point that if a lender introduced a special purpose credit program under ECOA, that an enforcement agency might take action against them under the act. That this December 2021 guidance pretty much eviscerated that concern. However, in February 2022, the interagency statement that Brad mentioned was paramount in really driving this all forward. And I also think it was unprecedented. When you look at what happened in that interagency statement, you see the nation's lead consumer protection agency. You see all of the bank and credit union regulatory agencies. You see the Department of Housing and Urban Development, the Department of Justice, and the conservator for Fannie Mae and Freddie Mac, FHFA. Never seen an interagency statement with that collection before, that broad. So it really kind of, I think, gave everybody a sense that they could move forward and that the apparatus was going to back their efforts to promulgate special purpose credit programs. If we could go forward. Thanks. So the historic application, I kind of mentioned there was this 45-year period where we really didn't see a lot of proactive special purpose credit program development by mainstream lenders. DOJ, in its guidance of December 2021, did point out that they have used the special purpose credit program provision as an enforcement tool. I've snippeted the specific case here, and if you go to the very end, they reference the settlement in United States versus Klein Bank is exemplary of the harmonious enforcement of the Act and ECOA, consistent with Congress's design. So again, trying to underscore that the Act and ECOA are harmonized. Really, however, prior to 2022, lender-driven special purpose credit programs are hard to find. Now, today, we are talking with the GSEs, we're talking with dozens of lenders of all types who are pursuing special purpose credit programs. The MBA recently partnered and released a special purpose credit program toolkit. The link is shown on the screen. They did that in conjunction with the National Fair Housing Alliance. And, when asked like which lenders are interested in this, I will say all lenders. Clearly, we're seeing some motivation, maybe stronger motivation on the part of banks who are subject to the Community Reinvestment Act. However, we're seeing it on the part of credit unions, and we're definitely seeing it on the part of independent mortgage banks. Carol, if we go forward. So what are we seeing? So let's just kind of pause here for a second. And in my realm of product development, effectuating our company's affordable housing strategy is part of that. And we take it very seriously. We have a senior management group that oversees our affordable housing strategy. We meet regularly. Special purpose credit programs have been front and center on our radar since early 2021, as we felt pressure mounting and momentum mounting for some movement in this area. So what we have is we have a mechanism in place to work with lenders who reach out to us and to basically go through what they would like to do and determine, will we insure it and under which terms and at which price. So we do have our standard published guidelines on our website, and those meet a great need. However, we do talk with lenders and have entered into agreements to kind of, if they have a very targeted approach that we think is going to be impactful, we will facilitate that with our insurance. What we're seeing in that process, and Brad alluded to this as well, the common characteristic is generally geographically defined. As Brad, I think the term Brad used is to not inoculate yourself from some regulatory risk. And I think that's exactly why lenders prefer a geographic focus. But the examples would be majority minority tracts or majority Black census tracts are the two most common. Not everything is geographically defined. However, we do see a lot of race and ethnicity based programs as well. Another key point here, typically when we think about serving underserved populations, we take in a low to mod income focus. That's not the case here. Many of the programs we're looking at are focusing on census tracts with no income restriction. And that kind of leads into the second point here, that the focus is generally on helping underserved people, classes of individuals, be better served in the financial markets. But there is also some focus on places. So a special purpose credit program is generally people-based or people-focused, but we're also seeing them be used for place-based solutions. An example would be, we have a number of lenders who are focusing on the geography of majority minority census tracts, but they're indicating that an individual who lives outside of that tract and who buys within that tract can use the program, or people who live in that census tract can buy anywhere and use the program. So they're trying to drive investment into, I'll call it a disenfranchised community, while also giving the opportunity for people in that community to buy wherever they want. Other common features that we're seeing, homebuyer education and counseling, not just, go and get your completion certificate, but more a structured way, making sure that the borrower's hand is held up to that point where they enter the purchase contract, and also supporting them post-close. We're seeing that be structured in. We're definitely seeing a rise in lender-funded down payment assistance with no lender cost recoupment. In other words, they're not premium pricing the loan and giving DPA to the borrower. They're actually keeping the rate as standard and providing DPA. So it's a true subsidy from the lender. Fannie Mae recently put out a lender letter announcing that you can do this on GSE loans, or on Fannie Mae loans, once the borrower own funds requirement of 3% has been met. Expanded interested party contributions, typically capped at 3% on 97s. We're seeing them go to 6% in some cases. We're seeing an interest in mechanisms to build post-close reserves. We ourselves are piloting a program called the Rainy Day Reserve. Interest rate buydowns and below market rates are common. We are seeing expanded LTV ratios. There seems to be a preponderance of 99 LTV programs coming into the market. There's some creativity around student debt and excluding it from the DTI or calculating it at a different level, like focusing on IBR type calculations and including that in the DTI. From a non-traditional credit standpoint, there's a view on expanding the guidelines and addressing the pricing. Borrowers who don't have bad credit but have no credit, typically, if you think about the conventional conforming market, are capped at a lower LTV and priced as if they have 620 credit. We're seeing programs try to price them more favorably and move that LTV threshold up. Expanded traditional credit criteria. This is not as common. In other words, we're not seeing as many lenders today come in and say, look, the program normally goes to 660, we want to go to 600. But we are seeing that in some instances, but it's not a very high instance. And then we are seeing in areas where there are appraisal gaps, high CLTV rehab programs, typically where the first mortgage financing is obviously south of 97, but the CLTV would go well above 100. And that incremental increment really reflects a forgivable second that is being used to fund rehab. Carol, if we go forward one more. I guess that's it. Well, thanks. I just wanted to kind of underscore the one final point. And again, we are not, as a creditor, we're not, I'm sorry, as a MI company, we're not subject to ECOA because it applies to creditors, but not us. However, we recognize where we are in this point in time and in the mortgage food chain, and how important it is that we support our lenders, and how important it is that we support our community partners in trying to achieve more favorable outcomes. Thanks.
Thanks, Jeff. You did it. For a minute, I felt like I was drinking from a fire hose of ideas for SPCP. So congratulations on delivering a lot of information to the group. But what is the major role or market role that MGIC is considering when it looks to create an SPCP?
That's a really, really good question. Carol, I think one of the things we really are trying to do is make sure that that this point in time, in terms of trying to address racial equity challenges in homeownership, lead to sustainable homeownership and wealth creation. The last thing we want to do is open a credit box at a point where maybe home prices have heated up a bit. We don't want to backslide. I've been in this business about 30 years now, and I've seen us backslide 3 times if you count COVID. And the backslide is always worse for underserved populations and underserved neighborhoods. So our focus is really, like I say, let's look at the written plan and let's work with the lender. And I can think of a number of occasions where we've actually provided input to the lender in terms of connecting them with groups that we are aware of in the communities they're trying to reach. And that creates a more holistic, I'll call it, ecosystem for success. Right. It's not about just guidelines. I mean, we've had this discussion internally. When you think of an MI company, you think of guidelines and price. We are trying to be at the table and help get the right results. And guidelines and price are just a part of the equation. And I would say probably the smallest part of the equation at the end of the day.
Thanks so much, Jeff. That was a great perspective to share with the group, and your willingness to work with lenders in our communities of higher need is really appreciated. So thanks so much for sharing your expertise.
Thank you.
Then our next speaker is Leticia Poole, and I hesitated on the last name because I remembered to get the first name correct. So I apologize if I made a mistake, but I am really excited to hear how BMO Harris Bank has worked hard to make this product available in a highly specialized small business market. So Leticia, if you want to open your camera, there we go. And we'll have you join us.
I am trying to open the camera and it tells me that you cannot start your video because the host has stopped it.
Okay, so I'm going to turn my camera off. That might help. And I know we had this trouble at the beginning, so I think Christy and Kat are going to work on this in the background.
Leticia,
and maybe if you just...
Sorry, you're now a co-host, so you can open your camera.
Okay.
There we go.
All right.
Well, welcome. And it'll be great to hear your perspective on working in a highly specialized marketplace.
Yes, and I've been taking notes too, so it's been definitely a pleasure. Thank you for inviting us and having us participate. We are very proud to be on this call and talk about SPCP programs, as BMO has launched our SPC program almost 2 years ago. So if you want to go into my first slide, this is just a little bit of information on BMO and our history and our footprint, which we will be looking to increase our footprint very soon. So our SPC program now is available currently in our 8 states. And we are looking to grow as we are entering into an acquisition with Bank of the West. So as we move forward, we're going to be able to offer our program to a wider range of individuals. If you go into the next slide, please. So really, when we thought about the why, so I always call this our why slide, right? And Brad and Jeff spoke very highly on the SPC programs and what's the purpose, why are we doing it? And the nice thing was BMO started to do the research in 2020 and possibly a year before that, really seeing how can we help close the racial and economic gap. And we committed to really trying to fuel the good for Black, Latin, and women in businesses. We know that these businesses are facing prospects of an economic fallout, and we wanted to remove these barriers for how they access capital and how they're going to access education and resources. So this is when we talk about the why, right? 8 million of 27.6 million small businesses are minority owned. These businesses are growing at an 11% rate versus a 1% for non-minority. And this last one here is when we say, why did we create this program? We've seen a need and we want to fill this need. 42% of our minority-owned businesses are reported having difficulty obtaining credit versus 29% of our non-minority. So again, when we think of why we created this, we are really committed to what we're calling our zero barriers to inclusion. We've committed a $5 billion 5-year commitment, which we're looking to possibly expand that as well. But one part of that program, we're dedicating $300 million to our Black, Latin, and women business owners in form of access to capital. And I'll talk to you guys a little bit more about the 3 pillars of our program and how our SBC program is unique amongst other programs. We can go to the next slide. So under our program, we wanted to make sure that this was a very comprehensive program. And yes, we understand access to capital is very important, but we also have 2 other pillars that I'll speak about. First is our access to capital. We want to make sure that we're helping business owners get better access to working capital. And what we've done is we've expanded our credit criteria and ensure that they are going to have competitive interest rates. So how are we deploying this capital? We want to be able to offer our clients a business line of credit up to $50,000 and or a business credit card. Now, when we first launched our program, it was a pilot in Illinois and Northwest Indiana, and it was just lines of credit at that moment. So for the line of credit, we were looking for businesses to be in business at least 2 years or better. As we thought to expand this program to the rest of our footprint, we wanted to have something that our startup businesses could also utilize under our SPCP program. So we've added the business credit card. So our business credit card can be utilized for startup businesses, which has really been great. And both of our products, so as we're offering access to capital, we also report to the business credit, which I think is also really important because many times we see that although capital is being offered to businesses, it still falls under their personal credit. Now, please note that we do look at personal credit to approve them combined with their business, but we're going to make sure that we give our customers the ability to grow their business by reporting to their business credit. So once the facility is approved and they have their line of credit and or credit card in hand, it now will reflect as a business liability. It now will go under their business credit. So that's another way that we're going to help strengthen that business, that entity, and help them grow and scale. The second part of our program, the second pillar, is access to education. And this is something that we feel extremely important about. I believe my co-head is on here with me, Vishan, and her and I, we're very passionate about making sure that we're building programs to ensure that we're not just giving the capital, but we're educating these businesses on their numbers, right? Many of our businesses, they're very passionate about growing their business and having their experts in their field, right, in their industry. But many times what we found out is that they don't really know their numbers, right? So how do we continue to help them really achieve that real financial progress in their business? So on our website, we have some practical tools and templates that customers and prospects alike can utilize. We have anywhere from how to do your business plan, which we know is always a hot topic for our businesses, our entrepreneurs, forecasting your cash flow, right? How to manage uncertainty. We have one that we teach a lot, which is called demystifying the loan process. And we go over the 5 C's of credit, but we really dig deep and make it very comprehensive. So many of our tools and templates are free and available for all to utilize. And in addition to our education, where we've created one that's a business acumen. So again, we really try to dig into the financials and help explain to our customers, why is it important to have a cash flow statement? Why is it important to have a balance sheet? And in addition to that, we wanted to take some more time on educating our team. So we wanted to make sure that when these customers come into our bank locations, they can sit down with the bank or with the manager, and they can make sure that they can have that conversation, that the banker really is trying to understand their business and understand the business's needs, because we want to make sure that we can improve that customer experience. So not only are we educating our customers, we're also educating our internal teams, so that way our customers really feel that they can come to somebody and have that personal banker that's going to walk step by step with them through the process. And our third part of our program is our access to partnerships. So access to partnerships, from Illinois to Wisconsin, we developed partners because we know that although we want to help as many clients as possible and we want to deploy as much capital, we know that we may not be able to approve everybody under our program. And as I mentioned, we did expand some of our credit criteria, but there is some partners out there that even have a more relaxed guideline than ours. So we partner with different whether they're chambers of commerce, urban leagues, CDFIs, and we partner with them jointly to do a few things. One, we want to help provide education with them. So sometimes we will do a webinar, we'll co-host and co-brand a webinar together. We'll do in-person or virtual. We will also we also refer our clients that potentially didn't get approved through the capital piece, but we refer them so they can receive additional coaching, so they can receive additional resources that complement what we've already given them, because we don't want it to be a no for our clients. We want it to be a not now. Work with this partner organization to position you and get you on track to come back to the bank, right? And continue your relationship with the bank. And what we found is that many of these clients, once we refer them over, although many of our partners do still offer an alternative funding, most of them want to take advantage of that coaching. They want to get that business one-on-one coaching and take advantage of those additional educational resources before they try to dive in to accessing capital. I can go to the next slide. So these are just some what we've done so far. What has our program, this is our program performance as of July 31st. We have helped a little over 1,600 clients, businesses approved. We've deployed 41 million in available credit. Now we have our credit card and our line of credit. So our average loan size is about $38,000 and our average credit card is about $10,000. So this is just to give everybody an idea of how our program has performed thus far. This November will be 2 years that our program has been in existence, and it's just been a year that we expanded it to our additional states. And just because we like to, as a bank, we like to see how we're performing, and just to kind of share the good news, we're able to win the 2021 Best in Biz Award. So it was for the program overall, and how that we were able to compare against different product categories for the program's resilience, our digital adaptability, and the remarkable growth. And then on the side here, we've just added a few comments that we've gotten from some of our people that have participated in our program, from some of our partners to some of the actual clients that have actually been able to utilize our program. And we can go to the next one. And these are just different ways of how we partner. So again, when the gentlemen were talking about, the SPC programs and what makes them different and the different components, yes, it's, the access to capital piece, but we really wanted to make sure that we made a very comprehensive program, that we are educating and partnering. And this is just to give everybody an idea of how we partner with our individuals. And this says that we've dedicated about 300 hours of education. I probably definitely need to update this. It's probably closer to about 500 hours now. But again, education and collaboration within our communities to our partners is something that's extremely important to us and a very important part of our SPCP program. Next slide. And this is just how you can contact us. We have our websites that we definitely welcome everybody to visit so they can check out all of our tools and resources. And then if anybody wants to contact us directly, you can feel free to give us an email, and we would definitely look to see how we can connect and collaborate.
So thanks so much, Leticia. It's been really a joy to listen. I come from a micro-lending background years ago, and so proud of the size of the loans and the flexibility with working capital. But I just wonder, what other small business market challenges does BMO believe the SPCP helps alleviate?
Well, I believe it's the education, right? So when we think of our program and what the SPCP alleviates, it brings resources to these communities that they did not have. We know that, depending on, for our particular program, it's Black, Latinx, and women. And what we found was that, and I don't know the updated ratio, and Rashawn may have disconnected now, but we had a nice percentage of our clients that came through our program, but they would have been approved through our traditional program. So what that told us was these clients, these particular segments, they look for special programs that are designed for them. So when we think of what it's alleviating, it's getting inclusion. It's letting them know that we are really trying to break down the racial and the economic barriers that are there, and really trying to help connect them and get them more education and resources that they didn't have. So yes, they need the capital, but we found that they need the education and resources even more so than the capital.
Thanks so much. That's such an important thing to talk about, that feeling of belonging and the feeling that education brings with confidence. And, these people are risking their livelihoods every day when they're self-employed. So thanks so much for sharing that. We really appreciate BMO's efforts. And we're going to move on now to Gabe Del Rio. Gabe is a specialist at HCA, and he provides the vision and technical assistance for lenders and CDFIs in affordable housing. We've had some interesting conversations on how he's gotten here, and I'm excited for him to do his presentation on what he sees as the role of SPCPs going forward. So Gabe, why don't you take it from here?
All right, thank you, Carol. And I'm actually going to share my screen, and if we can go through the PowerPoint, and then I'm going to take you on a tour of the SPCP Toolkit. So you should be seeing my PowerPoint now.
Yes.
Okay, great. So most recently, just this year, we've heard about, and thank you, Brad and Jeff and Carol, for providing great examples out there and explaining SPCP so that I can dive right into this. That December 7th announcement from HUD was really, really big, and it allowed us to move forward with implementing SPCPs in the housing space, because FHA had long been cited as potentially conflicting ECOA's provision for SPCPs. So when that came out, folks like me were finally able, and I've been tracking this for many years, we were finally able to move forward. And huge thanks out to National Fair Housing Alliance and the Mortgage Bankers Association, who worked directly with HUD to make that happen. And really, without that work, we wouldn't be able to talk about this in the mortgage space still today. So joyously we can, and we came together with MBA and NAFA to build this SPCP Toolkit. And this is a toolkit focused on mortgage lenders because you have seen examples of SPCPs in non-mortgage or non-housing lending for many years, including the small business space that you just heard from. But this is new for housing and mortgage. So we wanted to put together a toolkit for that. And I'm actually going to walk you through that toolkit now. So we're going to, you can find this resource on spcptoolkit.com. I'm going to go ahead and escape and stop share and reshare. And we're going to do a quick walkthrough of the website. So here we are on spcptoolkit.com. We wanted to put this together to be a resource where everyone could get this information and have links and resources which you can download. So right here at the top, we just put quick links to the rest of the site here, but we have information around SPCP basics, sort of why SPCPs are needed, the legal history and the social history there, and then a great legal FAQ section. I'll do a quick tour through to show you here. But we have the basics on what SPCPs are. You can easily share this, download it, copy paste it. There are links to all of the regs in here on the site as well. And then you've got all of the regulatory guidance and opinions. So someone asked in the chat earlier, could someone send out a copy of the advisory opinion or the general counsel opinion from HUD? Both of those are linked right here. If you just click on it, it should go straight to the document itself and you can download it. So back to the site, and we've got here the CFPBs, HUDs, we've got the interagency statement, which really had all of the prudential regulators from DC come together and support SPCPs, and then the HUD Office of Fair Housing and Equal Opportunity statement. Another really fantastic piece for use in discussing SPCPs and why they're needed is some history and background that NAFA provided for this. You may have seen their deck before, but you can now download a copy. You can go through this yourself on the site and help other folks that may not be on the same page as you get to that same page. This is another really excellent piece here that is very useful. This is an opinion paper, a legal opinion paper put together by Roman Colfax and NAFA, National Fair Housing Alliance. You can click to it, download it. It gives you a really fantastic and thorough explanation of SPCPs, the related laws, and gives you opinion on it. And that's located right here on the site. We also provided some background and research data from Urban Institute. We had them pull together a compendium of a variety of studies that they have done. And you'll see that they are summarized in this document here, and they all contain links to the actual studies themselves. You can flip through this on the site, and you can also use this, download it, and get to all of the links and all of the studies referenced therein. Here under, I should say, when we were putting this site together, we held focus groups of independent mortgage banks, depositories, and both internal and external counsel. And then finally, we reviewed this with the regulatory bodies, including about 100 and something folks from the Cfpb on the call. That was a high pressure presentation, but all have reviewed it and given us really fantastic feedback. In those discussions, we noted a variety of frequently asked questions and conversations. And so we thought this was the best place to handle those. And you'll see here, this is a big question. What are our legal risks with a special purpose credit program? Well, it gets pretty deep, but we break it up into 4 different areas. That's really well summarized, and big thanks to our partners at National Fair Housing Alliance and MBA for that advice therein. We also have information related to state laws and how folks can look at eligibility criteria and what you might expect from a risk perspective. We've also, and this is a section of the site that will continuously update, because you see there are programs that have been released, like Bank of America publicly, that will be added to the site. So we will continue to add examples. Our organization, my team is actually working on credit policy right now with the lending executive team. And so as these programs come out and become available, they will be added wherever the lenders are comfortable making them public. But we do have a couple of mortgage examples on here. We have some small business examples, BMO Harris, maybe we should add you to that. And if you shoot me an email with some info, I would be happy to help that happen. We've also got some nonprofit examples on here, the LISC Down Payment Assistance in San Diego. Our organization provides a national DPA program that's an SPCP. We built this because of this movement and because of this timing and because of market gaps in state and regional programs. I'll tell you a bit more about that. Another example by Home CFE, a partner in Washington, D.C. And then here you get to the section on building your SPCP. We broke it down into phases to help you understand the different steps in the process. You'll want to assess the data and determine need, design the credit intervention, build a written plan, make sure you hit all of your legal reviews and internal approvals, go for a regulator review of your SPCP plan, make sure to train your staff, and then of course monitor the program for effectiveness and for its monitoring plan, whether it should end or continue or be tweaked at all. So we broke that down into steps here, provide you with a great deal of information to help guide that process. This next section here, we've curated a set of blogs that are very useful for anyone who's building an SPCP. So you'll see the two blogs that UEDA already posted, the place-based and people-based from Urban Institute. There's a few others here that you might find useful and all related to SPCPs. Here's the FAQs on the data analysis section. What are some examples of SPCP credit interventions or policy changes similar to what Jeff just shared? We've got a variety of findings of data and then desired interventions described, and then sample credit policies. And we've loaded quite a few on the site here to lead folks, give you a headed start in those discussions and give you options to pull from. There's information about variances from the GSEs, about sharing your own internal data versus public data, and then what happens if you don't have, if you're not a bank and you're an IMB, can you still do an SPCP? And the answer is yes. I would tell you we're working on several right now. We talk about the needs analysis, and then we give you examples in this next section of actual data resource companies that can help you to perform the analysis or give you access to the data so that you can portray it. We've given you a checklist, a sample checklist for the data analysis for an SPCP. This one's based on home purchase. And we literally gave a checklist out for folks of all the data that should be pulled and analyzed in that. And then finally, in our data section here, our partners at Polygon Research provided us a really great deck. It's 76 slides deep, as you can see. This is one of our main data partners where our organization pulls data, performs analysis for SPCPs and for our partners. And this is a really, really deep tool. What we did here is we created a straw market and a straw bank. So we use real data in this analysis, but just picking a market in Ohio, actually. And we combined the data from several banks to perform the analysis, but it's real live data and it's a real example. A few more FAQs around compliance and monitoring related to SPCPs here, like loan officer pay, monitoring best practices and KPIs. One of the comments was about really anything that you're concerned could happen, a negative potential impact of an SPCP is something you for sure want to include in a monitoring plan. And I would just remind folks that no one's going to get it right, or sorry, perfect, I should say, but everything can be monitored and adjusted based on the data and the results. And that is exactly what a monitoring plan is meant to do. If you see, for instance, that a place-based SPCP is primarily being used by non-Hispanic white borrowers, that you would want to make some adjustments in that. And of course you would, because you would not be achieving your SPCP plan. And so those kinds of risks are things that you manage and mitigate through a monitoring plan. Finally, here we have our SPCP Toolkit contributors at Mortgage Bankers Association, National Fair Housing Alliance, and my organization, Homeownership Council of America, with some links there. Special thanks to Urban Institute and Relman Colfax, which is really a key player in fair housing law and has been a great specialty counsel we've seen for a variety of lender partners out there. One other section to call your attention to are the more helpful links. So we have a second page here, and that's got a bunch of trade associations, nonprofit partners, tools and programs that can be useful to SPCP providers. And so with that, I will stop share on the toolkit. And I hope you've enjoyed your brief tour there, and go back to my PowerPoint. All right. And I'm happy to take any questions about that. So I alluded to this earlier, a couple more slides from me for HCA. We have an exciting new national SPCP down payment assistance program. This is really groundbreaking in that most groups and areas are focused on limited geographies. And so we are a national nonprofit organization. So we began hosting national programs for partners last year. And this year we are in pilot for Equity DPA. This is a program that provides a no payment, no interest down payment assistance to LMI borrowers. So it's open to all borrowers at low income level. And it's also open to BIPOC consumers. So all of the HMDA categories that are not non-Hispanic white, open to 140% AMI. And so quick story to characterize that. And by the way, we've got these options because donors have different needs for deploying their funds to LMI communities, or to a BIPOC community, or to first come, first serve, or to any particular geography or group of states or geographies. And so we've solved for that all within our program. This partners with lenders and is delivered by our lender partners out there. And the quick story I want to tell you about Equity DPA is DeAndre's story, who we recently filmed for in the pilot. And DeAndre is a really great example of why we're doing this program. DeAndre is a young Black man. He's done everything right in life. He has gone to college. He has taken care of, he's gotten himself a really fantastic job at Microsoft, actually, a big tech company. Has a very stable job, excellent income that's very strong. He's got an excellent FICO score. He's got savings. He's got a 401k. He's just done everything right, but he lives in Southern California. DeAndre was the son of a single mother who used to take his sister and him through open house tours and through model home tours, dreaming of home ownership one day. She must have instilled really great values in her kids because they've done well. And here DeAndre is now finally a homeowner, but he didn't have in his experience, the experience that many of his white peers have, which is the ability to call mom, dad, grandma, grandpa, aunt, or uncle, and say, can you help me out with my down payment because I'm ready to buy a home? And that's because he's a first generation homeowner, like many people of color in this country. And he lives in Southern California, a place that's very difficult to save for down payment. So we were able to boost his savings, help him get into a home, and he now owns a beautiful home in Southern California. And he really is a great poster example of why we do the program. What you've been seeing in the SPCP Toolkit and in how we work on SPCPs with others is our CLIMB program. So that's our community lending initiatives and mortgage banking. This is our technical assistance program, our mainline delivery of our mission for Homeownership Council of America, really where we work with partners around the country to help them build products, programs, and delivery systems that provide access to credit for underserved communities. And we've given a couple examples of CLIMB engagements on the board here. We work with lots of CDFIs out there, but also investors, mortgage companies, home builders, folks that are building an affordable program and want to formalize that. And more these days, thanks to the regulatory updates or the clarity, we are working on special purpose credit programs. So the team is ticking away on one right now, but we are helping a variety of companies, national groups, to issue an SPCP plan. We help them with their research, product design, and their plan writing. And that's it for me. If you have any more questions or you'd like to reach out, there's our information on the board. You've got my email there, my direct number. Also, anyone interested in CLIMB or SPCP assistance, please reach out to myself or Jennifer. And you can also do that on our website. Oh, you're on mute, Carol.
Yep. Pressing buttons isn't always my best skill, but one of the things we talked about when we were planning are who are the biggest users of the toolkit so far, and where do you see it making a significant difference?
So we really shared that out. I mean, NAFA made a public announcement, but I would say the biggest share came from Mortgage Bankers Association out to the members. And what we've seen in the numbers on the site is we've had about 5,000 unique visitors. This is not something that was publicized widely. So we think that the majority of those users are folks in mortgage companies, mortgage lending, and legal counsel and fair housing organizations, and regulators as well. And so we've had a lot of visitors from the industry, and then we've also seen that they spend a great deal of time on the website. So folks are really reading the content, they're downloading the documents and all of the resources that we've linked there. And so that gives us a really great website score that we're happy to see. And the hope is here, Carol, that we will see many lenders come out with SPCP programs and that they proliferate the home lending market until we see the data shows that there's no more need for it. And because it's a data-based approach based on facts and results, it's really simple. We should do it because those are the facts and the results. We need to do them until those results are different, and that will take years to come. So the hope is many lenders come out with this, and it will take years of work, likely a decade or more of significant lift for us to really narrow the racial wealth gap.
Yeah, I mean, you guys as speakers, Jeffrey, Gabe, Brad, and Leticia have done an excellent job at explaining practical applications and the how to step into this. Now we're going to bring back online Kat and Christy to moderate any questions that have been brought up during the presentations as we check in and move along.
Yeah, thank you, Carol. We have a check-in here before we move into Q&A. Based on what you've learned so far, is there anything you'd like to learn more about? So broad issues that you are interested in, you can put that into the Q&A, and Christy and I will put it in the chat for everybody to see. And then in interest of time, Christy, if you'd like to share the next slide as well too, we can move into both Q&A as well too, to get time for our panelists to answer questions. So I will give everybody time. Oh, go ahead, Christy.
Yes, I was actually going to say we had one question that I thought that you and I were talking about. Well, I'll put in the chat too, but it might be a question for any of our panelists, but they had asked, a lot of SPCPs seem to be targeted at LMCT areas or MMCT areas that have to be utilized there. So could that be considered steering to a certain geographic area? And Kat just put it in the chat.
I think is a very interesting question. My first response there, and I did respond to that in the chat, is that that disparate impact that could occur, or that the risks of a place-based SPCP are exactly the key performance indicators that are closely monitored and are outlined in a monitoring plan. So, for instance, the biggest risk that folks have cited for a majority minority census tract program is that a white person, for instance, would be able to borrow that product in that area. And what if only or a majority of white borrowers were utilizing that loan program and purchasing or moving into and at the same time theoretically pushing out the residents of that majority minority area? And so that's precisely something that you monitor in a plan. And what I'm happy to say is so far, we've heard back from a few lenders who have place-based programs, and this is my guesstimate on based on this feedback of what it averages, but between them, something about 85% utilized by a BIPOC consumer. So it is majority, hitting minority borrowers so far, but these are things that will be very closely monitored. I'm also happy to say that, those lenders, when I ask them, what if you see that this is being mostly used or too, sort of too greatly used by non-target borrowers? And they said, we will switch to a people-based program if we need to. And so, those are the right answers, and these are the right ways to manage that risk.
Yeah, I would just add on the steering part of the question from a legal perspective. I mean, as long as you're making your SPCP available to the residents of an underserved community, and you're not insisting that they live in one area or another, I think your steering concerns are pretty low. They can buy a house in the area where they live, or they can move out of that area.
I'll just add on, and Brad, I'm glad you made that point. I think it's a really important point, and I think that's probably the type of targeting we're seeing more than any other is if an individual living in a majority minority census tract could buy elsewhere, or somebody living outside of that could buy in the census tract. Another form of targeting is, who are your community partners? Who are you channeling? If there's sort of a rush to use the program, how are you fomenting that rush? And typically it's like your community partners are the ones who are going to be out encouraging home buyers to consider a program, helping ramp them up, helping counsel them forward. And if those organizations predominantly serve underserved populations, that will also help drive that outcome as well.
Great. Kat just put another question that we had, thinking about how special purpose credit programs could also be developed to serve other underserved communities, if you will. So rural communities, native populations. We talk often in our Take Room Milwaukee program over the years over those with ITINs, so immigration status. And so there are some other opportunities there too, if anybody wants to speak to that.
Sure. This is Leticia from. I'd love to add. And under our program, it's nice to know that we do include ITIN. So ITIN is part of we can have lines of credit card accounts, everything. So we have added them, and great to also add that this is perfect timing of this call. We are looking to add native-owned businesses to our SPCP program as well. So for us, we are definitely looking to see how we continue to add additional verticals to our SPCP. And yes, we're extremely happy about adding ITINs, and we have many success stories that we can share regarding how we have been able to get capital in the hands of these business owners. And we're extremely excited to be adding the native-owned segment to this population as well.
Great.
Yeah, we pull data a lot, and I would say the native segment is one that you will, if there's a group that sometimes falls below the African American or Black American group, it would be native in many markets. And so it's definitely a very underserved market, and there are CDFIs specifically focused on those segments as well. But it's an important segment not to forget.
Right. And I'm going to we have answered the questions in the Q&A, but I'm going to ask Carol. I tried to message her, but she may not have seen it. One area that we didn't talk a lot about is just maybe a question around the other applications. I know Brad mentioned it early on, particularly related to consumer types of uses. So not just home ownership or small business, but Carol, I don't know if you probably have a better way to ask that than I do.
I think you did a perfect job of asking because, you know, the choice of product is probably by the sponsor of the SPCP, but, you know, Jeff or Brad or Gabe, are you seeing this take place in consumer markets, or even Leticia? She mentioned it with small business, that they are reviewing personal credit for entry point, but, you know, maybe speak to that consumer market, like small credit cards or payday advance type of products. I see this as an opportunity there.
Yeah, we recently built a couple of overlays for consumer lenders. So it's not usually our lane, but we sometimes get pulled into consumer and small business lending. And what we did on the SPCP side is to build an overlay that applied to a range of consumer products. And we actually built an LMI overlay, and we built an SPCP overlay. And that applied, those discounts essentially applied to a range of products. And those were all consumer loans related to energy and transportation.
Oh, okay. Jeff, it looks like you're shaking your head. I'm not sure, in agreement, or maybe you have a comment.
Carol, no, I was looking at the question that Kat put in. I was going to address that, but I can't comment on anything outside the mortgage credit realm because our focus is 100% in the mortgage credit realm.
Okay.
I'll just add one more, that for us, we've also, we have what's called a credit builder program. And the credit builder program is for all, right? But definitely can be considered under SPCP as well. It's a way to help our clients build credit for whatever it may be. And we recently have enhanced that to remove a credit score requirement. So basically, essentially what this does is this helps allow the consumer to rebuild, establish credit, and save money at the same time. So we are looking, when we kind of think of the Banked On initiative and the underserved and underbanked, and how do we help position these individuals for that home ownership, right? How do we ensure that we can put some individuals, put them in on a roadmap to those next steps, whether it's entrepreneurship or homeownership, or just really establishing credit just for themselves. And that's something that we actually just, we've had the credit builder program for some time, but really over the past few months, we looked at it, the benefits of it, and have enhanced that.
Thanks for sharing that, Leticia. It's an important product for consumers to establish themselves in the next step of their financial goals.
Yep. And then I was going to actually tap Jeff, if you will, for that question that we had posted about the home ownership rates. And we did earlier post a link to a recent Wisconsin Policy Forum report about home ownership rates and racial disparities comparing Milwaukee to peer cities, which just came out in the last month or so. So Jeff, if you want to answer that one.
Yeah, and I think what we haven't, and it was touched on very briefly, I think Brad may have mentioned it, but one of the things that we haven't really focused on is affordable housing supply, right? We're trying to overcome barriers that are, I'll call it, inherent in our credit system, so that we can help underserved populations afford home ownership or obtain market rate credit for other types of asset classes. But one of the things we really haven't focused on is how do we create more affordable housing stock that's quality, that when somebody buys it, they will find it to be wealth accretive to them over time, so that we break the cycle, right? Credit is built, wealth is created, home ownership is created, and hopefully we move on and grow on. That's been one of the challenges that we've struggled with, and I think to that end, we've been focusing on the high CLTV rehab component, but we've also been looking at outside of the traditional mortgage lending footprint, and in Milwaukee through the Community Development Alliance and its efforts, how can we advance how can we advance models that will result in more affordable housing? And that's taking us off the traditional stick-built home and into looking at other potentially panelized or modular type housing that can be affordably built. So it's all about hitting a price point that people can afford, but I also think it's about hitting multiple price points that people of multiple levels of affordability can afford, so that you're rebuilding a community that will sustain. So that was the point I wanted to make. And then I think one other thing, Letitia hit on a really good point about credit builder accounts. In one of the loan programs that we're working on, we actually finance an amount that becomes a rainy day reserve for the borrower post-closing. And that, of course, if you looked at the JPM Chase study of about 3 years ago, reserves is a very important factor in ultimate loan performance. So we're literally creating a reserve to buffer a borrower from unexpected expenses. And we think that that's important. One of the ideas that many partner lenders have had in that is maybe we put some of that money into a credit builder account for a period of time, so that 12 months out, the borrower not only has paid their mortgage on time, but they've paid an installment loan on time and they have a buffer. So sometimes these ideas merge together and create a more holistic solution for the borrower.
Yeah, just to pile on briefly on, that's a really important point. A lot of times, especially first-time home buyers, don't realize you have all these expenses once you're in the home. And so any SPCP programs that combine both down payment assistance, but also reserves for the borrower to be able to use to repair the home, take care of it so they don't lose it within the first couple of years, and they have a sustainable collateral they're able to keep.
Great. Okay, there was one more question in the Q&A, which Gabe answered live in the Q&A, and I'll just read it and then we will close out. But it's a little bit more complicated, but it was, could you create an SPCP that incentivizes multifamily landlords to sell to cooperative that is owned by the previous tenants so they can become homeowners? And that's where you see, again, I think Jeff talked about this like intersection of like different ideas that really speak to or try to meet the needs we see around affordability in particular. And so Gabe answered that, and that there might be a legal viewpoint that he thought Brad could answer. And one thing I will notice, we will collect these and put them in like a doc and send them out afterwards so we can add our answers in. But the idea is that the product could provide tenants with financing options and giving them the power to purchase. So I don't know, Brad, if you wanted to weigh in on that quick before we close out.
No, it's a good point. And yes, I mean, I think there would be the ability to do that as part of an SPCP. Yeah. Quick
Yeah.
answer.
It puts together all my favorite things right now in housing, I think. All right, well, we are going to close out. We want to especially thank our presenters. We have this slide with all their contact info, but there was also throughout. We will share the slides and recording. I just want to really give them all a huge cheers. They really timed everything very well. We knew we had a lot to cover. And so we appreciate you all sharing your expertise and time with us today on that. And I felt like Gabe and Jeff and Brad in particular were really great ways to talk about partners that you, particularly if you're a financial institution or a lender, but also on the community side, these like intermediary technical assistance types of folks that can really help us all do this work better, I think, and be smarter and more effective and innovative. So cheers to you all for that. And one more poll. We want to see if you learned anything today. So Kat is going to launch this poll. If you have a new understanding, or maybe you're still uninformed, I hope not, but. And
You see results are coming in very quickly. We've already got 8 answered.
Yes.
A lot of 3s and 4s, which is good. And I will share the poll, of course, after.
Yes. And so just to thank you all again, we have UEDA's website up there and then some upcoming events. So this is a series. Our second emerging topic will be featuring Milwaukee bids and NIDs, business improvement districts and neighborhood improvement districts. If you work in this sector, you're probably pretty familiar with them, but we felt like it was a good time to revisit them and talk about particularly NIDs. There's a few more of those coming around. So join us. That is in person. So you get to network and learn. We're very excited. And then in November, UEDA celebrates its 25th anniversary. So if you're in our network, you'll get an invite to that. We'd love for you to join us. And then our third topic will be held virtually, most likely in November or even early December. We are looking at potentially hosting one on community investment trusts or recent federal funding spending bills that are impacting the sector. So stay tuned on that. And I will just want to note too, that if you're interested in more of these topics, our Take Root Milwaukee program has done a racial disparities in homeownership webinar series for the last 2 years. And so hat tip to Bethany Sanchez in particular at the Fair Housing Council and our working group, Bill Kopka, Maria, and Irma. We analyze that HMDA data. So the Urban Institute calls it out. It's on the toolkit. Your Homeowners Disclosure Act data is a great wealth of resource. So we'll be doing another round of the most recent analysis of that. And last time we even talked about denial reasons. So looking into that. So those are all these data points that really go into an SPC plan. So having a good sense. So if you want to, we can include a link to those other webinars and slides if you want to kind of get up to speed, but look for information on that too. It's a great way for us to get wonky all over again. So again, thank you all for joining us. We appreciate you. Thank you to Carol, our moderator, who has always got such a great perspective and knowledge base to draw from, and Jeff and Brad and Leticia and Gabe and Kat for all of our work to help